Hi, this is Thierry Samlal from PMML. Today we'd like to present to you the multifamily market for the province of Quebec, the statistics for February 2022. So we're finished off with the year 2021 with a leveled off number of transactions. January, we had an explosion in our transactional volume for the province of Quebec, where all of the transactions that were supposed to take place in the second half of December 2021 and could not take place because of the holiday season were pushed back into January, which already had a high pipeline effective value. So basically January we had a record number of transactions. Now we're back to something more standard. So for the greater area of Montreal, we're at $280 million worth of multifamily transactions. If you're comparing to January we had a record number at almost $580 million worth of transactions. So we're about half right now, but when you're looking at December, we have about the same quantity. December, we were at $281 million of transactions that took place. Now, when you're looking at the greater area of Montreal, you have to divide that into different regions, either Montreal Island, east or west, or the North Shore of Montreal and the South Shore of Montreal. The North Shore of Montreal includes Laval. And what we're noticing is on that 280 million, there's 142 million that go for the Montreal Island itself. And almost half of the volume in transactions took place on either the South Shore of Montreal and the North Shore of Montreal, which is really interesting. So that can translate into what? Well, first of all, those transactions that took place in February were accepted offers that probably were accepted 4 to 6 months ago, which brings us at the beginning of the last quarter of 2021. So, or the summer 2021. So very interesting to see that already in that point in time where the price hike of the island of Montreal went high up and up, at that moment where we were starting to peak on the island of Montreal, well, that's when the transactional volumes went up in the regions. So, very interesting to see that maybe the return cash on cash in Montreal is lower right now for many investors. And for that reason, those investors are buying on the South Shore and the North Shore of Montreal. The other thing is that the price per door being on the rise on the island of Montreal, for the same return, people are looking to buy a lower price per door, either on the South Shore and the North Shore of Montreal. That being equally said, we have to look at the rents, which are on the hike and the rise for renovated products or new multifamily built on the North Shore and the South Shore of Montreal. And that attracts people for the same dollar invested, more return, even if you have to go outside of the city. So, interesting what COVID did, because COVID is kind of decentralizing the purchase power in Montreal. And that's an ecosystem. When the prices go up in the island, well, all of a sudden we get to a certain level, and that's where buyers go to South Shore and North Shore, and then the price hike, and then they come back into the island. So it's an ecosystem that rolls around. Now, February, we're at a time where we're post-COVID, economy is booming, inflation is on the rise, governments are slowly but surely increasing the interest rates and have done it importantly in the past few weeks. So we're in a system right now where the price per door is high and the interest rates are on the rise. So normally what should be seeing is we should be seeing a price correction. Right now it's not there yet. It's probably going to happen, But at the same time that we have the phenomena where the return is reducing because the capacity of financing is reducing on these buildings, buyers have to put more and more cash down. If we maintain the same prices, if we maintain the prices and the capacity of getting a mortgage is decreased, well, the gap in between of the mortgage decreasing and the price is cash down, right? So more cash down means less cash on cash return. Lower mortgages or higher interest rates mean that the capitalization factor is reduced, meaning that you are paying, with every dollar paid in mortgage, you're paying more dollars towards the interest than towards the capital, right? So when you're looking at any investment or a multifamily asset, you have three types of return. First type of return is your cash on cash. I put $1, how much do I get in revenue back on that dollar? How much do I get on excess revenue back in that dollar? Then, mortgages. If I'm paying $1 in mortgage, am I really paying that dollar myself? Or am I giving it to the bank, or am I paying it on the capital, right? The third factor is simply market gain and plus value on the product. And what happened is in the past last years, we have reduced return cash on cash. We have the capitalization factor, which is reducing because our mortgages the capacity to mortgage a property is being reduced because of hike of interest rates. Being compensated in the renovated products and the newer products by higher rents. And don't forget, if the rents go higher, less people could buy a home at the market price. So by the time the market price corrects for the homes, those people are going to be renting property and can rent it at high prices. So that being said, we have reduced capacity and return cash on cash, reduced capacity on mortgages. But on the other side, we have an incredible value add on pricing just by the general value of the market because of offer and demand. And in the past months, we've seen an incredible quantity of new buyers come into the market. We have the current buyers, which have picked up a lot of equity in their assets, that are refinancing their portfolios and their multifamily assets and their commercial assets, and are coming back on the market at the same time. So offer and demand. When you have that pendulum swing back up with high demand, well, then you can maintain the prices. That's being said, also, the prices for newer built property are on the rise. And the gap between existing property and newer properties, which are selling higher price per door, that gap is purchase equity, and that's bringing the prices up on the existing assets on the market. So, very interesting market with many different factors influencing the value of the property. And of course, with the world economy right now, which is more or less global, when something happens in the global economy, we're much more affected. A lot of people are going to put money into brick and mortar to protect against globalization and also against a hike in interest rates. So different factors on the market, but what you have to look at as the plus value that you're getting. I'm seeing a lot of property that's sold, that was purchased in the last year, sometimes at $100,000 per door, 110, 120,000. Going back that same property with nothing done on value add, going back on the market for 165,000 per door and selling. So a lot of people are making their money just with the plus value on the building, and no longer on just on the speculative, the speculation of the value of the building, and not on the cash return. Different market, different situation, different times. And 2022, I'm very curious to see what's going to happen in the rest of the first quarter. Let's talk about the Quebec market, which is Quebec, basically, where the old Quebec is, etc. That is picking up quite a lot in speed. We're close to $100 million worth of transactions that took place in February in a market where your standard is between, say, 40, 60, 50 million. So an extra 30 to 50 million. Why do we have that much volume? We had a lot of major transactions take place in Quebec City. A lot of major assets, portfolios were sold. Some by REITs, some from private investment funds also. And that attracted a lot of people to look at, oh, wait a minute, these major buyers are buying off in Quebec City. They know something that I don't. Let me check on it. Let me do my market value check. Let me see what my capacity to increase the rents are. And that has attracted a lot of players onto the Quebec market. That's what's going on right now. Gatineau, which is close to Ottawa, is at a healthy 14 million. Don't forget what I usually say. Gatineau, the volume that you're seeing here, 14 million, is not the correct volume, because what's happening is there's a lot of land being sold for densification and for multifamily build right now and for purpose built. And that value, which is hidden right now, because people basically are buying pieces of land, building on them, and building buildings which are going to be worth 300, 350, 400,000 per door. All of those buildings are going to be refinanced in a few years, or some of those are going to go in the market. So what you're seeing right now, 14 million for Gatineau, is an artificial number, because I could tell you that there's much more going on right now in that territory right now as far as multifamily transactions. Sherbrooke, which is a university city, which usually transacts at about 11 million. Right now, a very high volume at 73 million. Why? Because the schools are starting back, and there's a new level of confidence in that market, which is still under speculated price per door. If you're comparing to Quebec City, you're comparing to Montreal, greater area of Montreal, you can still buy assets at a lower price per door in those areas. And people that have that budget are going that way. So very interesting to see that that market is being maintained. Very high confidence in the multifamily market right now. Although we have interest rates on the rise, we're seeing a lot of people refinance their buildings at PMML. Right now we have over 1,500 exclusive mandates, and more than half of those are in the financing department. So imagine all of that money, which is going to come out of the equity of the buildings that are existing, and that's either going to be re-injected into those buildings by the building owners, because most of those financing is taking place with CHMC. CHMC is asking for that money to be re-injected into the multifamily assets that they're coming from. So either the owners are going to be renovating those buildings, hiking the rents, or that money is going to go towards multifamily or real estate purchases. So a lot of these players are crystallizing their money at the current interest rates, and they're going to freeze it there for 5 years. And then they're going to come out on a multifamily market where the interest rates are going to be a little higher, but they're going to have that high capacity to pay, because that money is crystallized at a lower interest rate. So in the next few months, we've seen enormous amounts of capital available in 2021. And we've seen incredible transactional volumes take place, because those players were coming back on the market, but that was not the total portion of the market. People that did not refinance in 2021 are refinancing now. And that money is going to be out on the market. So an enormous amount of capital that's going to be available towards the purchase of existing and new build multifamily assets. And on top of that, we have players coming from the rest of Canada pouring into Montreal, and those players pouring into Montreal are now interested in the multifamily assets. We have players coming from outside of Canada coming into Canada to purchase in territories like Vancouver, Toronto, which is going to make that they're going to have the capacity to buy maybe much more than the local players that are going to be more interested to come towards Quebec, because Quebec is going to be under-speculated. So imagine a major player coming in with euros on the market, or coming in with yens and purchasing in Vancouver they're going to have a much more, when they exchange their dollar or their currency with Canadian dollars, the capacity to buy is much more. So if they're buying very high prices in Vancouver, the local players might not be able to compete with them anymore, and they're going to be turning towards GTA, and GTA players are going to be doing the same thing, turning to Montreal, which is the next market that most players are going to be speculating on. So, which should bring in theory, a lot of construction into Montreal, a lot of value add is going to be done, and that's going to just hike in the market. If the rents continue to increase on the Montreal market, we're going to see a segmentation of the market. So some of the owners are going to be specializing into, say, social housing or socially oriented apartments, and others are going to be specializing into high rent apartments. Others are going to be specializing into to transit-oriented development sites. We're going to be repositioning existing multifamily sites. So what's happening right now is going to be very interesting for the market. I usually talk to you about my top 5, but I would like to talk to you about a major transaction that's taking place by a REIT, which is called Centurion. And Centurion has bought major shares, basically, into Habitation Trigon, which is a local builder that built enormous amounts of larger scale assets and that are all recent build multifamily units. So they were buying controlling shares and at prices which are very difficult to calculate, because what happens is when you have that many assets being purchased at the same time and you're buying controlling parts of those assets, well, in that case, you could have transactions taking place at $42,000 per door. I have a transaction here, which is $42,000 per door, which is normally supposed to be in an asset class that's worth about $275,000 to $225,000 per door. We have another example, an asset that sold for $40 million in Sainte-Thérèse, which is in the north end of Montreal, very accessible to downtown. And that asset went for that price, but normally is worth more into the $300,000 to $325,000 per door. So it's interesting to see the price that they paid, but you have to control that. You have to understand that that's to control the portfolio that they paid that price. But so they become like a partner, basically, of the constructor. Okay. In another sense, what's interesting to see is that Centurion is pouring that much money into major acquisitions, and we've seen these major acquisitions happen in the past 2 years in Montreal, and that only shows the confidence level that the Canadian market has into the Quebec market, and therefore into the greater area of Montreal's market, into Quebec City's market, into Gatineau's market, into Sherbrooke's market. Massive amounts of money are being poured into Quebec right now. And also, in parallel to that, we're seeing the CHMC becoming more and more flexible in their amortization periods. So now we have programs which are brought in from the CHMC with 50-year amortizations. And also we're seeing existing assets built in the 60s coming out with amortization periods approved by CHMC of 35 years, and some older assets even 40-year amortization. So even if we have price per doors which are increasing, if we have interest rates which are increasing, we're also seeing the amortization periods and the capacity to mortgage the properties being higher because of the amortization periods being longer, which is going to make a very, very interesting market. Definitely, we're seeing a large appetite for newer build. When you're talking about REITs and private investment funds, they definitely see the value add opportunity, which is very easy because you could already recycle the local population which are already in those buildings, your local tenant base, which is already paying a higher rent than the market, that has that capacity to stretch even further, to pay even further higher rents. And of course, the fact that you don't have any major capex to put into those buildings on the mid to long term, which makes the assets very, very interesting. I would like to, now I usually do the top 5. I wanted to talk to you about this particular transaction, which is a very important one, and it's going to attract other private investment funds, REITs, and major players to do the same thing, and to buy these newer assets on the market. So it's just a question of time before we see more and more players coming into the Montreal market. And some of them are going to find the Montreal market maybe a little expensive. They're going to go towards the parallel markets, and that's going to really boom multifamily in Quebec in the next few months. One existing asset transaction that I would like to speak to you about is one that took place in the south area of Montreal, which is Verdun, very close to downtown Montreal. Verdun has many assets of a 5 to 6 door category and has several assets of 30 doors and above. And this one is one that represents the market because it's a 1960 asset that sold at a price of $6,100,000 for a 36 unit. That's going to be repositioned. I had a chance to work as a lister for the owner that purchased this property, that took a property in the same area and then a major refurb of all of the units to create value add. It's right next to the public transportation system, which is the metro, which is the underground rail system in Montreal. Very well located asset. Did a repositioning with very small units and of small to mid size. Refurbed the common areas, gave that value add that the tenant base is looking for, the younger tenant base and the student tenant base is looking for, and definitely position the asset in a place where we're not talking about rents of $2,100 to $2,300 per month, but rents which are much more reasonable, and that makes the asset very much interesting. And then you could attract the right tenant base into the building. So this is your typical transaction that you're seeing right now in Montreal. I'm thinking about another transaction that took place on Bessborough in NDG at $182,000 per door. So you're seeing these transactions, $107,000, $182,000 per door. You're seeing some transaction at a mid-range of $200,000 per door in Montreal, not right now, for your lower size assets. And then, of course, you're seeing private investment funds, etc., buying much more larger assets, which they're seeing the much longer term, and they're opting for square footage in the units, and they're going for $400,000, $450,000 per door, and even higher in some cases. So, very interesting to see what's going to happen in the next few months. We're at the beginning of the first quarter. Very high quantity of transactions in January. Let's see what's going to happen in the first quarter, and with the possible hike in interest rates, which we're estimating should happen in the rest of the year, we're going to see what's going to happen in that case also. But a lot of capital that's going to be available in the market because a lot of people are refinancing right now, and that capital is going to come out in the market in 3, 4, 5, 6 months from now. And that's going to be liquid. So that's going to definitely influence the offer and demand. People are willing to now take less return cash on cash or inject more money cash down to maybe get lower return, but to play on the plus value that buildings have on the market. So stay tuned, March 2022 for the next market watch for the multifamily in Quebec, in the province of Quebec, and in the major cities in the province of Quebec. From there on, take care, have a great day.